All right, so twice a year, we do a recap of what's going on with the market, right? The end of the year, or I guess you might say the beginning of the year, going over the previous year, and then what we call the halftime report, which is the one we're in today, which goes over the last 6 months and tries to give some kind of semblance of understanding of where are we going for the next year, or 6 months at least. So that's what we're going to do. So we're going to look at where we've been, and we're going to talk a little bit about the economy first. As you know, typically when we're doing these workshops, we bring up the City National Rockdale speedometers, right? And the speedometers are basically indications of specific economic and financial indicators, and it gives us an understanding of where we are. And if we look at these indicators and compare them to previous months, it kind of develops a trend, right? So that's one of the reasons we use these indicators, is to give us an idea, where are we going in the economy? Are things getting better? Are things getting worse? Are they just kind of status quo? Well, when you're looking at the chart, and most of you are aware of this, if it's green, it's positive. So any blondes? How many green do we have up there? None? Okay, all right, well, that's good. We've got yellow, which is neutral, and then red, which is negative. Now, all in all, would we consider this a very positive chart? Probably not. Now, at the same time, does it look like it's a dire chart? Well, probably not a dire chart. We've actually seen it really red. I mean, if you remember 2008, towards the beginning, it was virtually all red. I mean, I think there was one or two yellows in the beginnings of the year. So we know what it looks like when it really, really gets bad. But we're not quite there yet. And again, this chart is the end of last year. And what it is showing is that we've got problems. But more importantly, what it's showing, if you start looking at the previous months, is the trend is slowly getting worse. Okay? And then at the end of 2022, if you recall, we went through the market, the first part of the market dip. Stock market dropped down about, call it 30%, 25, 30%, depending on which indices you're looking at. Then started coming back up in the last quarter. So the end of the year didn't look as bad as it did when we hit the bottom. But by the end of the year, there was also a lot of grumblings about, wow, we're starting to head into a recession. And there was a lot of controversy. Are we in a recession? Aren't we in a recession? And one of the big factors that created that discussion was labor and wages. Generally, when you go into a recession, labor and unemployment is high, and wages are coming down. But that's not happening right now. Unemployment is really low. Just go to the restaurants and you realize there's just not enough help there. And wages are really high. Just try to build something today. It's extremely expensive, and labor is a big part of the extra cost. Or we'll go back to restaurants again. If you went out to dinner to, let's say, Ruth Chris 3 years ago, two people, you probably could have gotten out with about $100. Now, it's about $200. I mean, it's just gone up that much. Even when you go out for breakfast, we used to be able to get like eggs and bacon for like $4.50. I mean, that was typical. I know now when we go, it's almost like $10 a plate. So it's really, inflation has really taken its toll right now. So when I'm looking at this, I'm thinking, okay, it doesn't look great. It doesn't look really bad. But if we look at it from a recession standpoint, again, going back to towards the end of December. And we think about the economic cycle. Now, just a quick educational piece here from the economic cycle. Economic cycles, kind of like stock market cycles, they kind of ebb and flow, but there's actually a rhythm to it. So the beginning of an economic cycle is called an expansion. That's where, companies are really rehiring, they're borrowing more so they can produce more. So there's an expansion in the economy. You get to the top and it's the peak. Okay, generally speaking, that's the best it's going to get. And then you get into the contraction. That's where companies are like, uh-oh, something's not going right here. I'm going to stop hiring. And maybe I'm even going to start laying off. And this starts feeding the unemployment. It starts feeding the wage drop, which isn't happening right now. And then when you get through the contraction and hit the bottom, that's the trough. Once we get through the trough, what happens? Cycle starts over again, right? And now we're going back into an expansion. Well, towards the end of last year, we were just cresting over and we're going into contraction at that point. So anybody have a baby? Contractions aren't really that fun, right? I mean, I don't know, but I have had kidney stones, so I think I have an idea of what the pain is. At least that's what the nurse was telling me. This was quite some time ago, actually, thankfully. So at that time, we were looking at a projection of either normal growth, slow growth, mild recession, or normal recession. And between recession and growth, it was like a 50-50 shot. Maybe we go into recession, maybe we don't. So things really weren't looking that bad. And I will tell you this is the longest prep time I can recall in history going into a recession. Usually it's like, oh crap, a recession's here. Everybody kind of pulls back. It's not happening that way. And Rocky will talk a little bit more about this as we go along here. So what has changed over the last 6 months? Well, you look at the chart, there's still red, still yellow. Now there is one extra red that we didn't have then. Now there has been some changes too. Some areas got a little bit better, some got a little bit worse. So let's look at the betters. Monetary policy got a little bit better. Housing and mortgages got a little bit better, not great right now. Inflation got better because inflation is coming down. But Rocky also talk about, where's the Fed on this whole thing and are we going to have more cuts? Geopolitical risk got a little bit better. So all in all, you look at that and you say, oh, maybe things are getting better. And then, well, these are all the negatives. So a few more negatives, the indicators go in the wrong direction. And this is very common when you're going from the peak into contraction. You'll have some shifts going back and forth. One of our biggest concerns right here is equity valuation. Now, equity valuation, for this to be negative, it means that the prices of stocks have to be really high. So high that people don't want to buy it. Matter of fact, they want to sell it and get out of it. So this is actually going the wrong direction because the market hit one of the bottoms in October. We don't know if there's going to be a second bottom. I don't think at this point the indicators are saying it's going to look as bad as it was in October. Many think there's still going to be a dip, but we just, it's the information is fluid out there. You're always trying to gather as much as you can to make the best decision moving forward. And you don't want to get trapped in a mindset of, well, in October, I knew it was going to hit here, so it's always going to hit here. You got to take all the data and you got to reevaluate all the time, unfortunately. But at the end of the day, we aren't looking quite as good as we were at the beginning of the year, and the beginning of the year didn't really look great. So where are we in the economic cycle now? Well, we're getting closer to the bottom. Now, but we're not there yet. Now, an interesting thing has happened, though, as time has gone on, and you think about growth versus recession, which one is it going to be? Well, the recession has kind of taken the lead here at a 78% chance we're going to get that recession, which also means there's a 22% chance that maybe we won't. And again, there's new data coming out that's feeding into this. And then the question is, a normal recession or mild? Well, I think we're going to be closer in this area here between slow growth and mild recession, with mild recession kind of hedging right now. So we're constantly watching this, and this is why I'm saying that this has been the longest preparation for a recession that anybody's ever had. And there's a lot of reasons for that, and Rocky's going to get into a lot of those down the road here in the meeting. As a matter of fact, we're actually going to bring them up now. So that being said, Rocky's going to talk about inflation, recession, what's coming next, and then once Rocky gets through this, I'm going to come back to the market again. So, Rocky?
Ready. Thank you.
I'm getting him into the slide here, so
we are good. Okay, I'm going to go a little deeper into inflation and the recession and what we're kind of seeing here. So first of all, look at this mountain chart. What we want to kind of talk about here for a minute is where we've been, what we've gone through, and where we're still seeing the issues relative to inflation. If you look at the left side, you go all the way back to January of 2021, we were comfortable at a very low 1.4% inflation rate. Been there for quite a while, right? It's been pretty calm, on the inflation front leading into 2021. But look what happened. Didn't take long and inflation really started getting bad about end of 2021. Then going into 2022, look at that. We hit 9.1% year over year inflation. Everybody remembers that last year, right? What was going on with food prices and everything. Try to buy a vehicle. All those things were crazy. The good news is the Fed raised interest rates, tightened credit, made it more difficult to borrow, things like that. And we've actually brought it down to about 4%. So there's been a lot done to reduce that huge problem of inflation that's totally unsustainable, right? You can't be paying 10% more every other month for the same things. That's not sustainable. So inflation is coming down. The Fed's target is still 2%. I think this last couple percent is going to be very difficult to achieve. In fact, I wouldn't be surprised if it sticks closer to 3%. If you look at history, 2.5% has been about the minimum steady inflation rate, and they're trying to get it down to 2%, so they really have a very aggressive target. When you look at the components, what's making up, where's the inflation coming from? If you look at the green bars, the tops of each of these bars, the green, that represents energy. And you can see back in May of 2022 how large the energy portion was contributing to overall inflation. Well, look what's happened over time. How that green bar has shrunk to the point that it's actually been negative. It's been deflating. So energy has been a big reason we've gone from 9% to 4%. The energy cost inflation has been going down. The next section, new and used vehicles in the red, same thing, okay? A lot of that was attributable to the chip problem. Remember that? I'm going to talk a little bit more about that. Couldn't get chips for the vehicles. They're sitting in lots. You wanted a car. You had to pay for it, right? Because there was so limited supply, which also drove up the used car market. Well, look what's happened to those red sections over time. That also has come down and actually is contributing to less inflation today. But the bottom two I want to focus on is the restaurants, hotels, and transportation, this light blue. You can see that grew, so it became a bigger problem as far as contributing to inflation over time. It's come down a little bit, but it's still pretty sizable relative to where it was over a year ago. And the bottom area, this dark purple, is shelter. Shelter is everything included for what does it cost to be in your home? Okay, so for some people it's mortgages, property taxes, insurance, just the maintenance. All those costs are kind of rolled into what they call shelter. That seems to be the most sticky inflation. You look at that and how this bar has grown and it's kind of stubbornly staying up. Okay, and we see that in home prices, right? Even with mortgages doubling over the last year, there's not a lot of inventory, so the prices of homes are staying up, okay? So this is where, when they're trying to go from 4 to 2, and you've got these two sectors still really, really struggling, and there's still limited supply of homes, so that is going to probably be a longer-term problem. We need more inventory to drive down prices, okay? This chart is very kind of complicated the way they put it together, but I just want to make a couple of points to it. Dan was talking to you about the leading economic indicators, right? The dials. This is a composite that the conference board does that tries to combine duration, how long the leading economic indicators are in a negative territory, depth, how large of a decline are we seeing in the indicators, and diffusion. Diffusion is how widespread is that, okay? And if you look, the red and black dotted lines kind of represent when we're getting warning signals in the economy, and the red is actual recession signals, not just warnings. And they're basically saying whenever we see a negative 4.2%, I got the number in red all the way to the left there, when we're seeing a decline of over 4.2%, that's pretty much the benchmark of we're going into a recession. And if you look all the way out here to the right, we've been signaling recession. This goes back into 2022 for a long time. Again, the point Dan was making that we've known about this, people started preparing and it didn't come, right? It's still not technically here. We're slowing, but we're not in a recession. We're expecting that to be towards the end of this year, first quarter of next year, but who knows? But this is one of the reasons I think we're projecting that it's not going to be as deep of a recession as we've had in the past, because we've had so long to prepare. It's taking so long. The economy is slowing gradually. It's not jumping off a cliff, right? And then when you look at this is just for some of the components that make up that 4.3% where we're at right now, decline in the leading economic indicators. The ones that are kind of boxed are positive. The others are negative, right? So it's a mix. In 2008, it didn't matter what you looked at, everything was negative. Everything was going down. So the diffusion, right? How widespread is it? It's not across all areas of the economy. And that's the whole point of this chart. So we have some positives offsetting the negative. Another reason we're believing it's going to be relatively mild. This chart took me a while to grasp, but once I got it, I was like, this is incredible to think about. We are actually, and have been for the last 15 years, in an experiment that we've never had before. What this chart is representing, and it goes back 100 years, it's representing private construction spending on an annual basis in the United States, and it's adjusted for inflation, so that's why we can call it 2.8 billion back 100 years ago, okay? So an adjusted for inflation number so that we can correlate it to where we're at today. How long had we been pretty steady in what had been spent in private construction for manufacturing? Pretty level, right? What's happened here? Anybody know what this is relative to? Remember the term quantitative easing? Fiscal stimulus? The government started an experiment in 2008, pumping money into the system for infrastructure, for different things that they've never done before. They've encouraged the private sector by giving them money to go out and do these things, okay? And the latest two that's taken us from here to here has been the CHIPS Act. Remember what we talked about the automotive industry? Didn't have semiconductors? What did the government do last year? Passed the CHIPS Act, put all this money out there to go build semiconductor plants in the US. So we aren't beholding to just a few providers, suppliers, right? So that's been a big part of this. The other one, they passed the Inflation Reduction Act, which I don't know what that means because I don't see anything in there talking about reducing inflation, but it had infrastructure package inside of it for transportation and equipment. Think electric vehicles. They're pumping money in the system. If you go around the corner over here to Brown Road to the GM plant, right? That's right over there off of Lapeer Road in Brown there. What do you see? Steel going up. Why is steel going up?
Electric vehicle construction.
Yep. They're revamping and preparing for electric vehicle production. In the past, who would have to finance that? GM. Private, they'd send out bonds. Well, the government's throwing money at it saying, we want you to go in this direction. Here's money to use to get this going. Okay? 194 billion in stimulus. It's an experiment. We don't know where this is taking us. We know it did help in 2008, but that's a big jump, okay? Another reason why the title says Fed stimulus, fiscal stimulus, likely to dampen or soften the economic weakness, make the economy stay a little bit more robust than a normal recession, okay? Then we look at this side of what's going on in the economy. Basically, as Dan alluded to, this may be the most widely anticipated recession in history. We've been talking about this since the beginning of last year. It's coming, it's coming, it's coming. We're still not quite there. We've been able to do things to kind of push it off, to lessen the financial impacts. What's really interesting here is when you look at two things: personal household debt and the ability for companies to pay interest on their outstanding debt. Okay? Here's where we're at right now. 9.7% of disposable income against debt is lower than in past recessions for the consumer. Look where we were in 2008. The consumer was highly in debt and we went into recession. What happens if you have no money and you get laid off? A little different than if you had a few bucks in your pocket and could ride it out for a while, right? Well, that's what's different today than in the past. Consumers are in better position. What about companies? Companies are in better position too. They're at a 13x ability to pay the interest on their outstanding current debt. That is, look at where they were in the past. Look what's happened to their ability to pay. Okay? You know what's caused a lot of this? We talked about inflation is coming, Fed's going to raise interest rates. Everybody got their house in order. You went out and borrowed money before the rates went up. Same thing with companies. They restructured their debt for lower interest rates for longer periods of time. So if you went out and bought a house 3 years ago and you're paying 3% on your mortgage, does it matter to you if it's at 6% today? No. You're not going to refinance. Reasons we're thinking that this recession can be very mild and we can get through this. The consumer's in a better position. Companies are in a better position. Okay? I'm going to turn it back to Dan. We'll come back to a little bit of the positives that we see in the market also. But Dan, bring us up to speed on where we're at today.
All righty. Okay, the markets. This is the real fun stuff, right? This chart represents 2022 and 2023 year to date, and its focus is really on the S&P 500 and each individual sector within the S&P 500. So the top row here, you'll see information technology all the way over to energy. Down here, the dark blue represents 2022's return for each one of the sectors, and the light blue represents 2023. Now, how many of you have been watching or have heard from time to time how well the S&P 500 is doing right now? I mean, really, it's up like 17%. Now, has anybody caught the fact that when you're listening to the S&P numbers and then hear the Dow numbers, there's a big dichotomy between the two returns? And you wonder why, right? Because historically, the S&P and the Dow would kind of run hand in hand. Yeah, you could almost be like, oh, well, we can talk about one or the other. It's the same thing when it comes to returns. But it's not happening right now. So the question is why? Well, if you look over on the left-hand side here, and you look at the 2022 numbers, you can see that information technology, communication services, consumers discretion, all got slaughtered last year, went down dramatically. But what's happening this year? Yeah, it's bouncing back. Now, you've heard us talk in the past about how last year's winners tend to be this year's losers and vice versa. That happens quite frequently. You can't say it happens every time, but it happens quite frequently. So when you're looking at this, you can see that most of the returns in the S&P 500 are coming from three sectors. Interesting, right? Well, I think it's interesting. Now, let's go over to energy. Energy in 2022 was at a ripping roar. This year, it's down. So when you look at the different sectors in the S&P 500, literally there's only three sectors that are moving forward as a whole. And then you're like, okay, it's up 17%. How could that possibly be? Well, these are all tech sectors except for the consumer's discretionary. But you heard Rocky talking about what? People have money. They didn't have it in the last recession. So there's actually money to be spent, and a lot of it is going to information technology and into communications. Now, you look at the center, which again, and you can actually come all the way over to energy with 2022. You had last year where all these were down, and right now, each one of those sectors are down. So it's like, okay, it doesn't look like the broad market is actually participating in what looks like the S&P on a bull run. It's literally the tech sector that's really driving what's going on. If you look at the NASDAQ is a tech-driven index. It's up like 40%. Well, some of these stocks are in the NASDAQ. The tech stocks are. That's why you're seeing the S&P 500 split away from the Dow and the rest of the market as far as returns go. Well, on this chart, I'm going to explain a little bit more why there's a separation. And if you look at this chart, we got three different indexes on here. You've got the S&P 500 capital weighted. Capital weight means that if you're a larger company, you're going to hold more presence in that S&P 500 than a small company that just got in there. So if I'm a real large company and I have a 20% return that year, and that real small company has a 30% return, who's going to affect the index more? It's going to be the large company. That's capital weighted. Well, in the capital weighted S&P 500, you've got 7 tech titans, which is what they've been named. And we've talked about it before, but these 7 tech stocks are the reason the S&P capital weighted is exploding right now. They represent 25% of the S&P 500 from a capital weighted standpoint, even though there's 500 stocks there. So another way to say it is there's 493 stocks that aren't doing well, but 7 stocks that are just ripping it right now. Some of these are over 100% up. Well, they were also 50% down last year. So some of them are just now getting back to even. Others haven't even touched it yet. Now let's go to the equal weighted. That's the Christmas tree one, right? The S&P 500 equal weighted, you can see by the returns, we're at about 7%, whereby the capital weighted is at 17. It's a 10% swing there. Now, what does equal weighted mean? Well, I guess you can probably figure that out, right? You know, that small company has an equal share as that really big company. They're all the same. So when you look at that, you're like, okay, we started at the beginning of 2023. We went up, we went down, we went up a little bit more, but we're only up 7%, which really, quite frankly, in a given year, that's not a bad number, right? But when you compare it to the capital weighted, it's like anemic. And then you look at the Dow's only up 4.25. I can go even further and say the Russell 2000 small cap stocks is up about 6%. The Russell 3000, which is 3,000 mid cap stocks, is up less. It's up like 4.5. It's closer to the Dow. So the broad market is not participating right now. They're saying, you know, I know that looks good, but we don't feel real good. We're still concerned about what's going on. We're still tightening a little bit. Now, one of the reasons to suggest that the tech companies are doing so well, one might be they're kind of flush with cash. Do they care whether interest rates are going up? Because they're not borrowing. They don't need to. Matter of fact, if they can get into a money market account at 5%, they're making 5% and they're not doing anything. They like that. No problems.
I'm an old guy. What are some of those tech titans? Is that Google and?
That's a good question. Yeah, so you got Google, which is now Alphabet. And matter of fact, I got another slide coming up, and you're going to see 8, not 7, but you're going to see 8 different stocks. I'll just bring it up right now. How's that? The first one is Amazon. And why am I bringing up these charts? Well, the reason I'm bringing them up has to do with risk-adjusted returns. Now, what's risk-adjusted returns? Well, I might be a very aggressive guy, and I look at a stock, and the stock is 90% chance it's going to be a positive next year. I'm going to take that risk. It's more than positive for me. But you might have someone else who says, yeah, but it has a 10% downside, and I really can't handle a 10% downside, so I'm not even going to get into that. The portfolio gets adjusted based on the risk level within it. So when I look at Amazon here, you can see, you know, the middle of last year, it was up much higher than it is right now. Now, Amazon, quite frankly, is on a tear right now, but it's nowhere near back to where it was because it lost so much in stock price last year. But what I want to focus on here really is the 2 triangles, the green and the red. The green triangle basically says out of 49 analysts, they're projecting that the stock could go up, in this case, 62%. But they're also saying, under the right circumstances, it could go down 26%. Now, if I'm a client who's like, you know what, I got a 10% threshold, is that a good risk for me? Even though the potential returns are really good, it may not be a good risk for me, especially if my whole portfolio is built on those type stocks, right? Well, I'm going to keep going here. We've got NVIDIA. That's another one of the 7 tech titans. NVIDIA is the same way, although NVIDIA is much better off today than they were last year or a year and a half ago. So 61% up, 28% downside. Microsoft, that's almost equal, right? You have as much chance to go up real high as you do to go down real low. That's a much bigger risk than, let's say, NVIDIA is looking forward. Netflix, again, nowhere near where it was. And Netflix, there's a whole lot more downside than there is upside potential for that specific stock. That's not one of the tech titans, but Meta is. Meta is Facebook. So Facebook, again, has a much greater chance of downturn than upturn. Apple. Well, everybody knows Apple, right? Again, almost an equal weight, a little bit heavy on the downside. So they're saying, you know, a little bit better chance that it's going to go down 27% than go up 24%. Here's a real good bet, Alphabet, which is Google, another tech titan. 53% upside with a 7% downside. I like that bet, right? That's a pretty good bet right there. And what you'll probably find is when you look in your portfolios, that stock's in your portfolios as well.
When did they change their name?
That was done pretty much last year, the year before. They went through a bit of a process on it. Conversely, you got Tesla. Tesla, there's a whole lot less upside than there is downside right now. And you're like, wait a minute, that's an electric car. I mean, they're pumping money in there. Why is there? Well, there's a whole other slew of issues going on there. The industry as a whole really doesn't like Elon Musk too much right now. Not that he's done anything bad. He's the opposite voice of what's going on out there right now. Or at least he would like to think he's pretty neutral about what's happening, but it's going against the grain. Now, when you think about all those tech titans, and you look at this chart here, this chart is really looking at artificial intelligence, how companies are using it, and how fast they're going from day one to using artificial intelligence to actually getting 1 million viewers looking at their company. So Netflix was one of the first to really jump into it. It took them about 3.5 years to get to 1 million viewers. Go halfway up here, Facebook started using it big time. Took them 10 months to get 1 million viewers. You go all the way up to ChatGPT, took them 5 days. Now, ChatGPT is on its 5th version right now. And 2 nights ago, I watched a interview of Elon Musk, which is kind of interesting. But Elon Musk actually started ChatGPT with another gentleman, Page, and I can't remember his first name. But it was designed to be an open architecture platform, meaning that no one person could influence what the program will do. Now, for those of you who don't know what ChatGPT is, it's basically a software program where you ask it a question and it's going to go out, grab a bunch of information and feed you that data. Now, it goes a lot further than that, because if I said, you know what, I'd like you to write a report on the rainforest decline, it will actually go out there, get all the information and write that report for me. So you got a lot of potential plagiarism going on there. But maybe you say it's not plagiarism because there's an AI actually creating it. It's individual. Now, why would I bring up the fact that Elon Musk was talking about this? Well, Elon Musk is one of the main voices out there saying, hey, we really need to slow down on this AI thing here. Because there's some dangerous things that could happen here. And one of the things that most people don't think about with AI is, and especially with ChatGPT. So if I'm doing research and I'm trying to get research, but I have someone at the helm kind of guiding where the information's coming from, could I slant the idea of that person doing research to go in the direction I want them to go? Yes, you can. Well, imagine if you could do that with the entire society. you put enough of the right information out there to potentially direct everybody to hate one country. Could that happen? Absolutely, it could happen. You get the right data out there because it starts to understand who we are. This is what Elon Musk is really kind of concerned about. So his concern is, before we go any further, let's get some regulations in place so you don't have a bunch of billions of bots out there going out getting information and influencing people, and maybe one or two people at the helm that's directing it. All right, now I bring all that up to say this. At the end of the day, AI is here, right? We're not going to get away from it. It asks, is it hype or reality? And I'm telling you, it's both. The reality is here, and there is a lot of hype going on with this. And companies, people, it's being used big time. So when you're looking at the different companies out there, and virtually, really most of these are tech companies, how is that affecting returns? Well, you saw the charts for all those tech companies. Those tech companies that we showed the charts on are all using AI to get the viewers, to get the sales. So it's really working if you want to just look at it from a business and logical standpoint. Now, when you're looking at the S&P 500, you got to ask, well, how many companies are using AI, and how are their returns relative to all the companies that are not using AI and the returns that they have? Well, you can see here, again, there is a pretty big difference. Companies that are not using AI have got about a 2.1% return out of the total return of the S&P 500. The companies that are, big numbers. So from a stock market standpoint, this is very relevant to how different companies are going to perform, which companies are going to be taking it on, do they have a service model that could use it? All this goes into what the analysts are looking at, looking forward, trying to determine which stocks should the portfolio managers buy, which ones they shouldn't. Is that kind of helpful with understanding how AI is now influencing the stock market? And unfortunately, it could actually influence in negative ways too. So that's the equity side. Now let's go to bonds. Now this is kind of a boring side. There's not a whole lot to it. But as Rocky has quoted many times, over the last 5-10 years, there's not been a whole lot of places to go if you're looking for a fixed rate of return that's really nice and no risk at the same time, or very little risk. But things have changed. I mean, as the Fed start pushing that rate up, all of the bonds, the treasuries, the money market accounts, all those rates are going up. Who was in GM demand notes back in 2000? They hit pretty much 7% at that point. I mean, why would you invest in anything else, right? 7% is a pretty darn good rate of return, and I don't have a whole lot of risk associated with it. Well, that disappeared for decades here, but it's back now. And as the Feds raise rates, which they're still looking at raising rates, you'll see the money markets shift. You'll see the treasuries shift at the same time. All right? So there are places to go to get some kind of yield out or interest out of the market now. And if you like to take a little bit more risk, you can go into high yield credit or emerging market debt and get stock market type returns. But you got to expect more volatility, more risk associated with it. So I say all that to say that we are literally using the bond market now where last year there wasn't any interest. So where did we go? Anybody know? Cash. Because we were trying to protect, right? The equities were going down, the bonds were going down. We were trying to protect. The only place you could go was really cash. Well, now there's an alternative, which is a very good thing. And you'll have, almost all of you will see that you have some kind of treasuries or money markets or maybe an increase in bonds in the portfolio, shifting away from the equities over the last 6 months. And, we'll see where we go with that. But that kind of brings up Rocky, because Rocky's going to talk about the headwinds and the tailwinds coming at us. So you can kind of get a feel of what are we looking at and how is it going to affect your portfolios. All right, Rocky?
Yep. Thanks. Okay. So this is a little bit on kind of what we're seeing as some of the issues out there and the opportunities moving forward. Obviously, geopolitical risk is a big issue, right? Ukraine, Russia, China, North Korea, that isn't going away. So that's something that we have to pay attention to and be willing to adjust based off of what's going on with the world, right? Future earnings of companies, even today, are still being kind of revised downward. When they say, hey, next month, here's what we think we're going to be earning, it looks to be a little less than they were saying a month or two ago. Okay, so that's kind of a negative. And that also plays into the fact that there's a lot of uncertainty with the Fed, right? They stopped raising interest rates last month, but they may do that again. They skipped June, okay? Every time they raise the interest rates, it reduces liquidity, it costs more to borrow, so on and so forth. So that's a big uncertainty. We believe we're kind of getting to the end of this, but there's probably still another 1 or 2 rate hikes coming before they stop. And the reason this one jumped on top of it is because the stock PE ratios are still a little high. The market has come back, some stocks more than others, not back to where it was at a high, but it's off of its lows. And really, with companies estimating next month's earnings going down from what they were forecasting, but the price is staying up, that puts the price earnings ratio out of whack. So we believe prices are still a little bit high overall. Looking for an opportunity here in the next few months where they will get back in line, get a slight correction in the market, and that's the time to really look at, okay, what do we buy looking into 2024 and 2025? But things are still kind of slowing down in the economy, and it's being reflected in the earnings reports of companies and bank stress. We had bank failures this year, okay? Does anybody understand really what was behind the failing banks? I'll kind of explain it to you very, very simply here. What's happened is banks have a certain amount of cash they have to keep on hand to pay depositors when they come in and ask for money. They also are supposed to keep a certain amount of what they call reserves, okay? Well, where have interest rates been over the last 5 or 10 years? Real low. So treasuries that the banks were buying to hold in reserves were only paying about 1.5%. But that's their reserve base, okay? They're sitting on all this money with low interest coupons on it, low interest rates on it. When there was a run on the bank, they didn't have enough money to go out and pay the depositors, so they were supposed to go sell assets, which is the reserves. Guess what? Because interest rates are now 5%, nobody wanted them. They couldn't sell them. They couldn't raise the capital to keep meeting the depositor demands. The run on the bank caused the bank to fail. Okay? So now you've got all of this old paperwork out there with low interest rates on it. The government's got to try to unwind all this in this process. So we kind of created the problem for the banks by raising interest rates so fast over the last year that their reserves became worth less and less and less. Okay? The government bailed it out. They said, we're going to come in and back to those depositors, right? And then the government's friends come in and buy the banks that are failing at 10 cents on a dollar, and supposedly everybody wins. But the risk is still out there because there's still a lot of old debt, low interest paying notes that these banks are holding in reserves that got to be kind of flushed out of the system. So they're trying to do that. The good things, we have a lot of good things going on too. The recession is looking more and more like it's going to be very mild. It's getting delayed. It's less and less likely it's going to be deep. So that's a good thing. I talked about the solid consumer and business balance sheets, right? People are in a better position today than they were in the last recessions, okay, to ride through a downturn. We've reached a bear market average length. Does anybody know what the average length of a bear market is? Between 18 and 24 months. We're already 18 months into it. So we believe we're kind of at the back end of the cycle, and that's another reason that you kind of see the stock market stabilizing and people feeling a little bit better about things for the future because the stock market is future looking. But we're already into the average length of a bear market for the stock market. The Fed did skip the June rate increase, which gave us a chance to take a breath and not worry about how high our mortgage is going to go and car loans and things like that. Volatility is relatively low, okay? You look at this chart on the bottom. This is the volatility index. Pretty relatively low when you look back into the prior years, okay? So the stock market has stabilized somewhat. It's not as volatile. It's not moving every day when Russia does something or doesn't do something like it did a year ago, okay? So all these are kind of tailwinds. These are things that we're looking at and saying, you know what? We maybe need to be looking at what's going to be coming in 2024 and 2025 and investing for it now, not wait till we get there. Another thing that is a positive, Dan was talking about how only some companies are driving the market up because they're so big, and the others are lagging. Well, guess what? This is the history going back about 70 years on what happens to those lagging companies after you see solid gains in a narrow rally. And tech is the one that's rallying the most, so that's a narrow rally, right? Other sectors are not. Well, we're not sure if it peaked, but when it does, what tends to happen with these lagging companies, within 3 months, they start increasing on an average of about 2.8%. So they start playing catch up. So those tech companies will probably level off a little, and some of these others will start to play catch up from a stock market standpoint. 6 months later, on average, up about 5%. 12 months later, 16%. Another reason we want to say, you know what? There's companies out there that their prices are still low. They're solid companies. There's a good chance next year they could look really good from today to next year. In the next 12 months, we could see some really decent gains moving forward. And then this goes back to the consumer being in a really, really good position. Investors' flight to cash has been followed by strong returns. When you look at where we're at today, because interest rates are higher and more people have gone into CDs, money markets, bonds, and things like that, there's a lot of money available out there. In fact, it's historically high. There's $5.43 trillion kind of sitting on the sidelines that was pulled out of the market as the market crashed and is just sitting there making some money finally, but waiting to say, hey, show me that I can do better in the markets. Look what happened back in 2008. When cash peaked, money sitting on the sideline is when the market actually hit its trough and started to recover. Where did that money go that was in cash? Back into the market. So when do you want to get into the market? When everybody else has done it? Or be buying when it's low and letting everybody else come in late to the game, right? So this is a real positive. There's a lot of cash sitting on the sidelines. And I was asked, why is that number so high? The reality is during COVID, what did the government do? They wrote you a check for doing what? Nothing. What did most people actually do with that money? No, they actually didn't. A lot of people did, but a lot of people didn't. They actually saved it, invested it, held on to it. That's why we have so much cash. The government was just giving money away. Okay? It got pulled out of the stock market as the market declined, and it's sitting on the sidelines saying, give me an opportunity and I'll invest it in the future. So that's out there. Okay, that is strictly supply and demand, right? When the demand for stocks go up, this money is going to start flowing back into it. Okay? So that's kind of the positives we see, or the tailwinds, headwinds kind of moving forward. Now I want Dan to come up and kind of finish with how do we apply this to the portfolio. So,
all righty. So can you imagine all that money on the sidelines? That is just incredible. And so I want you to think of it this way. If you think about the stock market like you would shopping for furniture, all right? So you've got all this money on the sideline, you want to buy furniture, but you're really looking for a sale at this point. If I can get a real good deal, I'll spend that money. And you go to Costco because they got some great deals, and you find, boy, they don't have anything on sale. What do? You walk right back out because you know there's going to be an opportunity down the road where they have another sale or another company is going to have a big sale. So you're just going to wait and time it to get in when the opportunity is there. And the same things happen with the stock market right now. There's a lot of money on the sideline, but the PE ratios are really high. It's still expensive out there. So all those people who have the money on the sidelines, they're going, you know what, I think I'm just going to wait it out a little bit. When I start seeing the numbers look good and I see things that I want, then I'll buy it when the price is right. So that's what we're looking at as well. So when you talk about our strategy, first let's talk about fixed income. Fixed income, again, you've heard me talk about this. We were in cash before because it was the only place to be. Now we've re-entered the bond market. So we have money in the bond market. The bond market, if you know treasuries are bonds. That's what one of the main focal points are. It's not that we don't have others, because we do, but this is where the cash has gone. Since the yields are up on the shorter bonds, we've actually laddered the portfolios. Now, that being said, when you see what's going on with the indicators, where we are in the economic cycle, you're like, okay, do I want to reinvest that back into another longer treasury? Or is it time to go back to cash so I can jump back in the market? Well, our thinking is, let's not reinvest in a longer treasury. So you'll see in the treasury portfolios that when a treasury comes due, it's in cash. When there's enough money there, we'll stick it into a money market. So we have cash there making money, and we'll be ready for when we see the opportunity to start moving back into equities. So one of the things you got to be mindful of, and one of the things we look at, is as the Fed levels off, in other words, stops doing the rate hikes, which they're still saying that there's going to be 2 more quarter-point rate hikes. They could change their mind, but that's effectively what they're saying. The stock market, on the other hand, thinks that they're going to start lowering rates today. That's not going to happen. We talk about some of the catalysts that could drop the market down, and that could be one. They think they're going to get a rate cut, and the Fed comes back and throws it up another quarter point. That, in combination with other bad news, could actually drive the market down and create that opportunity to start buying things on sale. So we're going to be looking at the Feds really leveling off Q3, Q4, and that's when you'll see the rates on the money markets and things stop raising back up because the Feds are no longer raising rates. And that's why we say it should be leveling off. The equity market, very selective and somewhat defensive in the portfolio. Many of you have, let's say, JP Morgan value. It's value. We went from growth stocks to value stocks. We wanted to be able to get paid a dividend at the same time holding equities and potentially get the growth. Some may have Federated. Federated's lagging right now. Be patient. It'll swing back up again. So if we see a dip in the market and people get a little bit wary, guess what they do? They go out of growth, they go to value, value gets pumped back up again. So we're kind of watching that. We are adding selective dividend companies. We're trying to get the highest dividend out of the portfolio. Again, get paid as much as we can, waiting to go back into growth stocks. And then as the market really expands, probably Q3, Q4, we're in Q3 now, we're going to be looking at shifting over to growth companies. So I've said a lot there when it comes to the market and what we can and cannot do. And you probably have if you got a mental picture, you're thinking, okay, the market's got to do this, the market is going to buy here, it's going to sell it. It's a timing game. I mean, to the extent that we have to watch the economic indicators and then make the move at the right time. And it could be a measured move, you know, as we go along, going back into the market. So when we're looking at portfolios for clients, we're looking at everybody from an individual basis when we're making the moves. Everybody has just a little bit different risk tolerance. Most of you have a little bit different portfolios. So we're looking at each individual client when we're making these moves. Now, that being said, if we have a big move we got to make, we're going to make it all at one time. How do we do that? Well, we already have a plan on how to get back in. So now it's just executing the plan. That's why we have Asset Mark as our back office, to be able to execute within 2 or 3 days. You know, what you don't want to be is the person who gets in, okay, you get this line where Dan's going to start trading everything in, or Rocky's going to start trading everything in. I hope I'm in the first of the line, because if they're doing it themselves, it's going to be next month by the time the last guy gets there. That's not going to happen. That's why we have the back office. We want to get everybody in within a reasonable time so everybody can take advantage of what's going on with the market. The income ladder treasuries, again, we're at about 4.7%. Some of you are in higher yield. Why? Because you like the risk. It's okay. Others are like, I'd rather be in the treasuries. I'm making a pretty decent amount and I don't have to worry about it. So it's not across the board, but we are a bit selective there. Income growth, value stock tilt, again, we're at a point right now when we're looking at each one of the clients, looking at your risk tolerance, making a determination. How protected do we need to be within your portfolio, and how much risk does the client really want to take? Because the reality is we start moving from the value to growth, there's going to be additional volatility, because there always is when you're shifting markets. And then long-term growth, again, we're going to be looking at more growth stocks, going back to the old style portfolio. When I say old in the stock market, that's only like what, 2 years ago? We're not thinking about our age. We're talking about the market here now. So we're going to be going back into growth, more tech stocks, and more global allocations. The global market isn't really doing real well yet. So we're going to be selective as to where we go in there, which countries we would go into. Same thing happens with our money managers. Again, most of our portfolios are driven by institutional money managers. And they're the ones that are making the same type decisions we are making as a whole for our clients. And if you think about it, with these institutional money managers, most of them are looking a little bit defensive right now, just as we are. So you've got a lot of analysts, you've got a lot of smart people that are still saying there's risk out there. We could still have a downturn. Now, will the downturn be down to where it was in October of 2022? Most people think no. But could it drop down to 43, 4,200 on the S&P, which would be a pretty decent drop from where it is right now? Yes, that could easily happen. And actually, that's what we're looking for as a catalyst to start moving back into the market. One of the things we're looking at. All right, so that brings us pretty much to the end. Then we are done. You guys get to enjoy that beautiful day. I know it was sunny when you came in.